Today we're tackling a topic that we have not hit in the past. We're going to be talking about reverse mortgage lending. To do so is in local expert David Tourtillott from Homestead Mortgage. Dave, thanks for stopping by.
Thanks for having me, Chris. Appreciate it.
Now, I come from the residential traditional mortgage financing side, and I know enough to be dangerous when it comes to the reverse mortgage, but it's really a completely different animal.
It is. It's a home mortgage. Just like in your world, I refer to it as a forward mortgage. This is a reverse mortgage. So they've basically taken the financing part of it and reversed it. So people who are 62 and older can borrow money against their home and use a percentage of the equity in their house and borrow that, also known as equity, and not have a monthly mortgage payment. So hence the name reverse. The financing part of it's been reversed, where the bank pays the borrower their equity and they don't ask for a payment in return. So it's pretty simple. Home mortgage, think of it like that. It's a refinance of someone's primary residence. They got to be 62 and older to qualify. It's a federally insured loan. FHA and HUD invented this loan back in 1989. And they oversee it, they regulate it. And so it's a nationwide loan. There's only one game in town. It's the FHA reverse mortgage. Folks may have seen it on television. They might see it on the internet, a local bank. It's the same loan in all 50 states. So there's no bank or lending versions of a reverse mortgage, only the HUD loan at the moment.
Who is your primary candidate for a loan like this? Are you seeing a lot of people that just turned 62 apply for it, or is it somebody that's a little bit further down the road?
It depends. I mean, most of my clients that come to me, they might be looking for some additional cash. Maybe they're on a fixed income, and most people 62 and older are. So they're on fixed incomes, and typically the cost of living outpaces their fixed income, so they're looking for a way to supplement that. And this is just another option to consider. In addition to a home equity line or getting a job, they can do a reverse mortgage, and allows them to access the equity in their house based on their age. And they can use that money as an income supplement because, as I mentioned, there's no monthly mortgage payment. So they borrow the money, and the money gets repaid in the future when they no longer live in the property with the unpaid interest. It defers. So I've had folks come to me that are looking for a way to set up an emergency reserve account. So they might do a reverse equity line of credit. And maybe they're not in an income they don't have a financial problem right now income-wise on a monthly basis. They just want to have a backup account. So they set up a reverse equity line of credit, which allows them access to, again, a line of credit. But when they access that line of credit, unlike a home equity line of credit, they access it like cash, and there's no monthly mortgage payment. And that line of credit grows over time. A home equity line does not grow. It grows income tax-free over time because they're getting older. So typically, a good person that might look into this might be looking for, additional income, like I had mentioned. Someone might be looking to do home repairs. Someone might be looking into it because they want to remain in this house for the rest of their life. They've decided to do that, and they need to modify it. Maybe they need to widen the hallways because they're handicapped, or remodel the bathroom, whatever the case may be. The bottom line is the equity is theirs. They can use the equity for whatever reason they want. Any reason.
That's pretty cool, because I think that there's a lot of people out there who have gone with the traditional financing, and they I'm just making up numbers here, but let's say they bought a home in the late 70s, early 80s, they've raised a family there, they paid down their mortgage significantly, doing mortgages for almost 20 years. I've seen a lot of people when they have education costs, kids going to college, etc., they tap into the equity on a mortgage that they spent years paying down.
Yep.
And they're not taking out all the equity, but a decent chunk, but they're also getting to that retirement age. And then they're hit with that crossroads of, okay, I want to retire. My income, in most cases, is going to be reduced on a monthly basis. However, I don't want to leave my home, but I can't carry that nut, or if I can carry it, I don't have a lot of extra cash laying over. It sounds like that would be a perfect scenario for somebody like that.
Yeah. When I sit down, usually I'm sitting down with the entire family. Mom, dad, kids, we all sit down. I ask them why we're here. And that's always a good way to start the conversation off. Why am I here? And they'll tell me, well, mom and dad want to stay here the rest of their life, and we're helping them out with monthly bills at the moment. So we're trying to find another way where we don't have to, take on that liability, find a way to help them pay for those bills. And so this is one way we're looking at it. We're also looking at a home equity line. So it's really just an alternative. It's another option in the mix. You can sell a house to get your equity, as you know. You can stay there and do a home equity line. You can stay there and do a cash out refinance and a forward mortgage in your world. Or you can do a reverse mortgage. Or the family can help pay for your bills. So there's only so many ways if mom or dad want to stay in the house and they're struggling financially. To figure that out, we'll go through all the different options, not just a reverse mortgage. We'll talk about a home equity line to see if that makes better sense than a reverse equity line. We'll talk about, hey, you want to sell the house? No, we don't. Okay, we've canceled out that option. Have you considered a regular forward mortgage refinance? Well, we don't qualify because of our income. So it's a conversation like that. And if we all come to the agreement that this makes the most sense for mom and dad, then we talk about, how that's going to fit for them.
Very cool information. I'm joined right now by David Tourtillott. If you're just joining us, he does reverse mortgages with Homestead Mortgage. David, just so I get this down, in regards to options for a reverse mortgage, you have your cash out option where you're taking a lump sum versus a home equity line of credit, reverse line of credit, correct? Yep. So there are two main options?
Yeah, there's multiple options. So let's use an example. Let's say your mother and father own a house that's worth $400,000. Say they're 70 years old. They'll be able to access about 50% of the $400,000 based on their age, so about $200,000. So that $200,000 can be taken in multiple ways. They could say, we don't need it. We just want to have it sitting in the sidelines in the form of a line of credit. Or, hey, I need $40,000 to pay off some debt, or we need to pay off an existing mortgage, which we have to do anyways, and we'll leave the rest in a line of credit. Or they'll say, hey, we want $1,000 a month, $100,000 line of credit from that $200,000, and we want to pay off some debt. So you can chunk it out in multiple ways. And that's the flexibility of it, is they can do whatever they want with the money. They can take a payment every month that gets deposited and have part of it in a line of credit. They could take some money at closing in a lump sum to pay off immediate debts, such as credit card debts, or maybe something needs to be done to the house. So it's equity that's available that can be structured in multiple ways simultaneously. Line of credit, monthly payment, lump sum. Or just all line of credit, no payment, no lump sum. Or no line of credit and just a monthly payment for the rest of their life that they're living in the house. And that can all be changed too as you go. If you progress with the mortgage later in their life, they might want to change the payment method of that money.
Sounds like no matter what, for anybody that's in that stage of their life, it's a great option to look at if needed. Been doing mortgage financing for almost 20 years. I know you've been in the game for a long time as well. And I feel like years ago, reverse mortgages kind of took a hit, right? There was a bad rap tied around them. People took shots at them, similar to like an interest-only loan or a neg-am loan. Yeah. Which reality of it is certain loans are good for certain people. It's not a one-size-fits-all, but they took a bad rap. Why do you think that happened, and what has been changed to make sure that it's a solid product for somebody?
So great question. So I know why that happened. I'll tell you a story. So back in 2001, I got into the forward business. So I originated forward loans for 2 years and originated my first reverse mortgage in 2003. Fell in love with the product, researched it, figured out what the problem was in the 90s. So 1989, FHA and HUD invented this loan during the Reagan administration. Okay, they invented it, not the lenders. They invented the loan. They put it out there to the lending institutions and banks and said, hey, here's a new loan for people 62 and older for their primary home as an option, which will provide financial stability over a period of time. That was the mission behind it. So, like anything else, the loan's out there to the lending institutions, and what happens is you mix human beings and lending institutions, and they have a new product they have access to. They looked at that product as a way to get at older people's equity and do unscrupulous things with it. So what was going on in the 90s, to be honest with you, Chris, is financial advisors and reverse mortgage advisors were in cahoots.
Yeah.
And they would go in and extract equity in the form of a reverse mortgage out of a 75-year-old's home. And then they would come back later and say, hey, we know you have access to that money. Why don't we put that in a couple of annuities, or let's do some, crazy things with it.
Yeah.
So again, HUD invented the loan.
Yeah.
So it was never the loan that was the issue. It was the human beings that were using it as a conduit to get the equity of an older person, which we both know older people are vulnerable to unscrupulous people. So that's where the stigma came from. Someone back then might say, oh, I did a reverse mortgage and I lost my house. Well, it didn't really mean they physically lost their house. What it meant is they did a reverse mortgage. A couple of gentlemen came back, or even females came back, and convinced them to take money out through their line of credit and give it to someone to invest. And they lost the money.
Yeah.
The house still has a mortgage on it, deferring interest. That never changes. So they lost the equity in their house. So HUD catches on to these things, and they put in new disclosures. So HUD catches on to it, and there's disclosures that are now signed at the time of application and closing, asking the borrower if they intend on doing anything out of the ordinary with their equity, such as investing in financial instruments. So that's before the loan closes now.
Got it.
There's a yes or no box. So if they check yes, right below
Red
that,
flag. Yeah. Explain.
they explain with who.
Yeah.
And during underwriting, someone might make a phone call to that firm and say, why are we investing Hazel's money after she closes? So there's a lot, what I'm getting at is there's a lot more protections in place now that the loan's 29 years old. And that's just what happens. Someone invents a product, puts it out into the marketplace, people find angles, and here we are 29 years later, and there's a lot of safeguards in place now for seniors. So it's a very safe loan. It's a 310-page loan application that I print out for each loan.
I was going to ask you, how different is it from the regular application?
310
310 pages is a lot different than 4.
Yeah. Now, I don't want people to get scared of 310 pages because 2/3 of that is a copy of everything they're signing, plus more things HUD wants that person to know about in advance.
Sure.
So it's very transparent. So that's really where the stigma came from. And it's still there. To be honest with you, some people you might run into and say, hey, you thinking about a reverse mortgage? Oh, I would never do that. Well, why? They don't really know why.
It's just
things they've heard about in the 90s. And so anyways, that's...
I'm sure a common question that you get is can you run it out of equity? If somebody's getting a monthly payment for the rest of their lives, what happens when that exceeds the value of the property?
Great question. So a reverse mortgage is a non-recourse loan. And that sounds like a fancy term, but all it really means is there's zero liability for the heirs, the children, the borrowers, and the institution. It's a federally insured loan, so there's a fee that's paid upfront mortgage insurance premium that goes directly to HUD. And that money sits there in case the borrower outlives the loan. The loan debt exceeds what the value is at the time they no longer live there, and the children inherit this property that's upside down. Well, the bad news is the kids don't get any money because it is upside down. The good news is they're not liable for the shortfall, and they're not going to have a judgment cast against them because there's a shortfall. Zero liability loan. So if there's any equity left, mom and dad take a reverse mortgage out, pass away in 10 years, maybe they only use $200,000, and the kids inherit a house and they sell it for $400,000. Well, the remaining $200,000 still goes to the kids. That's not shared with the bank or the government. So
it's really amazing how things get misconstrued and people hear something negative and think it's automatically a bad product. This is a great product.
It's not for everybody.
Yeah.
It's a more costly loan. That's the thing. Everybody says, it's so expensive. Well, there's a reason for that. What we just talked about.
Sure.
In order to have your kids not liable for this loan and the borrower's not liable, well, it costs money for that.
Sure.
So if you take the insurance out of the equation, it's not that much more expensive for a regular mortgage than a reverse mortgage. You still have attorney's fees and closing fees and an origination fee and a cost for the person handling the mortgage origination. They get paid too. But regular mortgages are not federally insured. Forward mortgages. they're insured by the person's payment, and if the payment doesn't go to the bank for 3 months or longer, they could be at risk of foreclosure. There is no monthly mortgage payment obligation with a reverse mortgage. Disclaimer is they have to pay their taxes and insurance. That's a payment. They're responsible for that, but the monthly principal and interest part, they don't have that as long as they're living in the property.
Great information. A lot goes with the reverse mortgage. If you want to reach out to David and his team directly, you can go to their website at homesteadreversemortgages.com.
Yes, homesteadreversemortgages.com.
And remember, we have more real estate information just like this right here on boston.com.